Welcome to the daily update, where I'll go over the action in the market for Tuesday, August 29th, and then we'll see how things look for Wednesday, August 30th. So much for trading sideways. It was kind of believed that with this being the last unofficial week of summer before Labor Day, that volume would stay below average, which it has, but that the market would pretty much tread sideways until things were to be decided next week. All of that went out the window in Tuesday's session, where we're seeing a lot of improvement. We're switching back over to a more positive stance now, where we're seeing a big improvement with a lot of our indicators. And unfortunately, when we've been chopping sideways and then we have a big move like this, we already have a number of our short-term indicators that are giving us extreme positive readings. Now, you can take those two ways. You can say, okay, we're overextended to the upside, or that's just suggesting that there's good momentum. Before I get started on the video, please be aware that I am doing a free online course. The first session will be Monday, September 4th, and that will be all 3 hours together, where I'm going to talk about my approach to technical analysis. I'll go through some basic strategies, and then the last hour, I'll go through support and resistance. Then the following week, from Monday to Wednesday, September 11th through the 13th, I'll be doing that same class, but I'll be doing it 1 hour at a time to kind of break it up a little bit. I will be recording this, so if you miss that, I'll be posting it on YouTube and Rumble for you to watch if you desire to do that. Or if you attended and you want to rewatch it, you're welcome to do that. My intentions are to stream it on YouTube and Rumble as we're doing this, but I've had some problems with that before. If we do run into a situation, I'll be using Zoom as backup, and I'll make sure that the link is available in case that happens. Let's go back and talk about what happened on Tuesday. Right at the open, we had a higher open, not much of a gap, but prices quickly went above R1 at 44.44, and then we got up to R2 at 44.54. As the day went on, we just kept going up. We climbed above R3 at 44.78. We almost reached R4 at 45.03, so we're dealing with that 4,500 level again. We closed at the high for the session, and just, this is incorrect, it was just slightly below 4,500. We were up 1.45%, but volume was below average. And you can look at that a number of different ways, but we've been seeing below average volume consistently now throughout the summer, and so it should not really be a surprise. The technicals are turning more positive now. We were showing some improvement over the last few trading sessions. Well, this just kicked that into higher gear. We're not full-blown positive yet, but we are turning more positive, and it's about inflation, interest rates, and growth concerns. We're going through this idea now that good news is bad news and bad news is good news. Well, a lot of the economic reports that came out in Tuesday's session were weaker than expected, which would be bad news. Well, the market is taking that as good news and justified interest rates coming down, which helped stocks really go up. What are some comments that we can make? The S&P regained its 50-day simple moving average, and I've been harping on that a lot in the recent videos. That was currently at about 44.60, so we got above that, and we closed just below 4,500. Declining interest rates did give stocks support. Growth outperformed value. That's what we want to see on a solid up day. And then the current scenario, are we starting to shift into a new scenario? Not really so much right now. The idea being that the economy is stronger than expected. Well, we saw some weaker than expected economic data that switched things more positive, and that the Fed will need to keep rates higher for longer. Okay, we've known that. And as we get weaker economic reports, that throws this whole idea that maybe the Fed will have to raise interest rates into doubt or into check, at least for right now. Now, this could change at any time. We have the big employment report coming out later this week. We have the PCE report. We have the ISM reports coming out, at least one of them, the manufacturing report. Any one of those could just shift this back to negative if they come in stronger than expected. We're also a bit concerned about what's happening in China because they're experiencing a weak economy right now. And in fact, they're stimulating their economy to try to get it to pick up. On a short-term basis, we already have our Stochc RSI, the Williams percent R, the CCI 14, and the stochastics giving us extreme positive readings. Again, you can take that two ways: extended too far to the upside or showing good momentum. The dollar was down and interest rates were down, and both of these provided support. We still have all of the yield curves that we follow that remain inverted. Sentiment is still neutral. It ticked up from 47 all the way up to 50, but that's still the neutral category. Our trend, it's now turning more positive. The green line has crossed above the red line on our ADX on both the short term and intermediate term. However, we haven't turned up above the moving average on either the short or intermediate term ADX indicator. Our bias is positive and our momentum is now switched over to positive. We've had 3 up days in a row. The economic reports that came out, the FHFA Housing Price Index came in up 0.3%. Last time it was up 0.7%. The S&P Case-Shiller Home Price Index on a year-over-year basis is down 1.2%. They expected it to be up 0.9%. Last time it came in down 1.7%. Consumer confidence came in weaker than expected at 106.1. They had expected 116. Last time it came in at 114. The JOLTS job openings, and this was kind of the big one that influenced the market. Now on Friday, we could get another report coming out when the unemployment and employment situation report is due that totally contradicts this. This report that we received on Tuesday and how it's calculated for Friday are completely different, and they often contradict each other. But the job openings dropped to 1.827 million, 1.8827 million, which is still a lot of jobs, but we're seeing a real decrease in that, and I'll show you the chart. Last time it came in at 9.165 million. Here's a chart showing the price index, where it's continuing to go up overall, showing that prices are continuing to advance. And then we look at the home price index, where it's also continuing to go up. Then here is the latest reading for consumer confidence. And we have 3 things on this chart. The purple line is how people feel right now, and it's decreasing. The total, which takes everything together, that's the blue line, and it's also going down. And then the expectations look out into the future, and that's also declining. We want people to feel good, but we don't want them to feel too good and then get too overexcited that the economy is just magically going to keep going up and up. Then looking at our next report, these are the job openings. And even though there's a good, healthy number, we have been seeing a real decline in this over the last few months. And the market liked that. And the market used that as a chance for interest rates to come down and stocks to go up. We're also keeping an eye on this. This is the VIX, taking an average from 1990 up to 2022. That's the blue line. The red line is what has happened so far in 2023. If we follow the same basic average, then that means that the VIX will go up, which generally means the stock market is going down. We also had the smooth U.S. recession probabilities update. I'll go over this again in the weekly video. We only get concerned when we get up to the red line, even though it is coming up. So we're a little bit on warning now. Sorry, had to clear my throat. But it really gets bad if we get up to the red line and we're not there yet. We're also looking at another chart that I do show in the weekly update. I think it's in the intermarket analysis video, where we're seeing a long-term downtrend in interest rates that could be starting to reverse. And maybe we're coming into the old norm now, which is what it used to be before about 1980, where we have a higher interest rate environment. And is that going to be what the market's going to have to deal with going forward? Looking at the intraday chart, we didn't really gap, but we quickly went up to R1, we shot up to R2, and then we just kept going higher up to R3. Eventually, we didn't quite get up to R4. We closed just below that, and we also closed just below 4,500. Here's a look at growth versus value, showing how both of them were up, but growth really outperformed. The growth to value ratio for the S&P, this is what I pay attention to the most. We're above the unchanged level. We had some good gains right off the start. right off the bat. And then we held on to those gains and closed just a little bit off the high for the session. So that's positive too. Looking at the VIX, we were down on the line chart and the bar chart on an up day. And volatility is really starting to drop off with the VIX as well. But this is still a little bit of a concern. This is a 5-period moving average of the equity put call ratio, and it takes a little bit of time for this to shift when we're seeing a real change. These should start coming into the calculations because we've had 3 days that were up after a number of days that were down. So we might start to see this come down, but for right now, it's spiking above a pretty extreme reading. And here's the longer term look at that same chart. We just want to keep an eye on this one. We look at the VIX to VVIX ratio. Longer term, it has been declining, but lately it's been turning up. At some point, if we are turning more positive, this should start to turn and come back down, but it hasn't done that yet. Also, longer term, we have been declining with the 253-period simple moving average of the equity put call ratio, but we've been going up as we've been going through this weakness in August. It's going to take some time, but if we keep going up, this should also turn down. Then looking at another fear gauge that we haven't looked at in a while, this fear gauge does show where we're starting to drop off. And then we're seeing a bit of an improvement with the ratio between risk on and risk off. We had been going up nicely, then we hit August and we were falling back. Now we're starting to see this go up again. Can that continue? On a short-term basis, the Stochk RSI is now extreme positive, as is the Williams percent R. The CCI 14, just barely extreme. And looking at our trend, where the green line has now crossed above the red line. However, the ADX is still below its moving average and it's still below 20. So this could be signaling some kind of a shift in the trend, and it's going to take a few days for the ADX to actually pick that up and start to calculate that. And we're seeing pretty much that same thing in the short term, where the green line's crossing above, the ADX is below 20 and below its moving average. So we're still in a trendless environment, but we're possibly in the process of switching from negative to positive. On the daily chart, we were able to come back up to this pivot level. It's hard to see with that big P right in there. We were able to get above the 50-period moving average and then close above that. So this had been overhead resistance that the market has been able to break through. And we're seeing that on the different indexes that we also follow that I'll show you. But on the bottom, we can see where volume continues to be below average. On a short-term basis with the stochastics starting to get extreme, turning more positive in the intermediate term, and starting to go back up in the long term. So this chart is showing improvement. Now, please be reminded that this is a further subdivision of the short-term time frame. So the top is short term, and then intermediate short term, and then long short term. Then we're starting to come back up to the double and triple exponential 50-period moving average, where this blue line may be providing some resistance. It would be a little bit more positive if we could stay above both of these lines and then get above the blue line and close above the blue line. We're also seeing some improvement with our highest high and lowest low values, where we were able to get back above the midpoint. As we were going down throughout August, we never did recapture the midpoint here. The fact that we're now breaking above that is turning things a bit more positive. We're seeing the red line, which is the lowest low value, start to go sideways, and the blue line, the highest high value, had been declining and starting to flatten out. If we see more follow-through price action, that would turn this up and make things look more positive. The summation index, which was showing some improvement after Monday, starting to turn back up based on price, but just barely at the zero level. We're starting to turn up based on volume, and actually this led by a few days. So this may have given us some kind of a heads up that we were seeing a change in trend. The NYSE McClellan oscillator, or the S&P, that's just for the S&P 500. This is the NYSE, which takes a broad measure, and it's a much bigger look at the market. We finally were able to cross back above zero, so this is turning more positive. So we're just ever so slightly starting to turn up with the NYSE summation index based on price and volume. The NYSE bullish percent index, after dropping below 50, has now turned back up and crossed back above 50. The Swenlin trading oscillator, which did give us a couple of days head notice that things were showing the potential of improving. But again, we've also looked at this chart and it gave us an early warning about something, and it's been wrong. So we just kind of take it as it comes. But we are seeing an advance based on price and volume. The NASDAQ 100 bullish percent index just barely coming back above 50 after it had dropped below 50. So this is also showing some improvement. The Copic curve is now generating a new buy signal. It had been declining throughout August, and now we're starting to turn back up. So that is more positive. We're still wondering about the mass index. We have not reached the blue line yet. It will only be a signal when we get above the blue line, turn back down, and then cross below the red dash line again. At that point, we're looking for a reversal in the trend. We're seeing some improvement with the advanced decline line, turning up based on price and volume, and we're still above the moving averages. Also seeing some improvement with the new highs, new lows. We saw an expansion of new highs, a contraction of new lows, so our 5 period is starting to turn back up, and our 10 period is starting to turn back up as well. We're seeing an improvement here with the advanced decline ratio, where both the blue line, and it's hard to see, but the red line is also above 0. Accumulation distribution, we're starting to come back above the moving average. This is trying to measure what is the smart money doing, and when we see this going up and showing improvement, that gives us more confidence that the smart money is really doing some buying. Looking at the NYSE cumulative advanced decline line, also showing some improvement. The regular advanced decline line also showing some improvement. In fact, we're starting to come back above the trend line. We had broke below that. Now we're starting to turn back up. So that is showing an improvement. Our advanced decline line studies, we're coming back above the moving average with the NYSE, the S&P, the mid caps. The small caps are lagging a little bit, but showing some improvement. The Chaikin money flow also tries to measure what is the smart money doing, showing some improvement, but still negative. Looking at our oscillators, and I can't zoom in on this chart when I use Zoom, which is kind of ironic, but we're turning back up in the short term with the slope oscillator and the TSI, showing a little bit of improvement with the MACD. It could be getting ready to cross over positive. The PMO is looking better, and the PPO is also looking better. Longer term, we're still negative. If we see follow through with this, we'll see these other oscillators begin to turn up. Our moving averages. Yesterday, I pointed out that we're going to have a hard time getting above the 50-period moving average. I mentioned that like 6 times. I also mentioned that we might be seeing some overhead resistance from the 20-period moving averages. Well, we just blew through all of those in Tuesday's session. Looking at the PMO study, where we're showing an improvement with the PMOs that are rising, we're no longer extreme. We're just barely above this extreme reading with the buy signals and starting to turn back up, and flat to slightly turning up with the PMOs that are above 0. So this chart is also showing an improvement. The Elder Impulse system for the S&P, it switched to positive after Monday, and it's even more positive after Tuesday. Another thing that I mentioned was that the close for the 20-period moving average of the closing value was acting as overhead resistance. Well, we were able to break through all of these lines, and if we stay above this, it'll turn this mini rainbow back up. So that could be showing some improvement. We're also coming right up to this intermediate term trend line. This might be an issue. We closed right at this level. Can we break through that? Or is this going to provide overhead resistance and then cause us to come back down? This is kind of a little more negative for right now until we can really close above this line. The Ichimoku cloud had been providing support. We're still in the cloud, but we are showing some improvement. And then I have our different variations of charts where the Heikin Ashi is looking more positive. The Kegi chart is also looking more positive. That's a black line that's pointing up. The Renko has drawn in an open box. That's turning more positive. And the 3-line break is also in the process of turning more positive. We also saw some new X's drawn in on the point and figure chart. Not enough to generate a new signal, but we had been seeing O's being drawn in here. And the fact that there are new X's is suggesting that things are turning more positive. Longer term, though, we want to keep an eye on this. The MACD on a weekly chart continues to decline. The growth to value ratio for the S&P, this is a little bit of a warning sign too. Even though growth did quite well, it didn't necessarily do well when it applies to the S&P 500, where we were pretty much flat after we had declined in Monday's session that was also an up session. So this is a little bit of a warning sign, even though longer term, it still continues to be in an uptrend. Dow theory, based on the traditional use of Dow theory, showing a nice little advance with the Dow, a turn up with the transports, but not as much as the Dow advanced, and we saw a bit of a tick up with the utilities. The Dow was able to get above its 50-period moving average, and now we're running into the monthly pivot level. Now, this level is only going to last for another day because it's going to switch as we go into September, but still, this is providing some overhead resistance. So this has a positive side where we were above the 50-period moving average, but negative in that we haven't been able to break above resistance. The diamonds, though, have switched from being neutral over to positive. And then the NASDAQ 100 also running into a conglomeration of resistance with the pivot point, the 50-period moving average in the previous high. We were able to close above that. So that's showing a lot of improvement. The Qs remain positive for the Elder Impulse system. We're also seeing an improvement. We're actually crossing above the moving average with the NASDAQ 100 PPO. And this is kind of what happened, not quite as bad as, or it's a little worse than what happened in March, not quite as bad as at the end of 2022. But the fact that we're starting to turn back up is also suggesting the NASDAQ 100 is showing an improvement. Here's the NASDAQ, where we were able to get above the 50-period moving average and the pivot and actually close above those levels. We also were able to get back above the 61.8% retracement level based on the Fibonacci studies. That is positive for right now. The question is, can we stay above this level and continue to advance? We were also able to get back above the 50-period moving average with the FANG index. Small caps, after battling with their 200-day moving average, have come back up to their 50-period moving average. They still have overhead resistance with the 50-period and the pivot level. The small caps, though, have switched over to positive for the Elder Impulse system where they had been neutral. Looking at the Russell 2000 small cap index, we're climbing above 50 with the RSI. That's positive. We're coming back above this resistance level, and we were able to close above that. That's turning more positive too. The MACD is still negative, but it's starting to turn up. And if we see more follow-through upside action, the MACD should cross over positive. The mid caps, we came right up to resistance at the 50-period moving average and at the pivot level. So showing some improvement, but we still have some more overhead resistance. And we're also showing for the Elder Impulse system that the mid caps are now positive after having been neutral. We really saw the 10-year yield go down, and that gave a lot of good support to stocks. We saw the price for the 10-year bond go up, but we are working off of a recent death cross. The RSI is just barely above 50, but showing some improvement, but the MACD is starting to turn over positive. Are we going to see a shift in bonds where interest rates go down as prices go up? Looking at Tom Bowley's research, which suggests that the end of August, we tend to see some downward action. We have other information that I'll also talk about that contradicts that. So what's our outlook for Wednesday? We still are dealing with earnings reports, but it's not as heavy as they had been as far as the number coming out. We are turning more positive with our technicals. We will get the weekly MBA mortgage applications index, the 80 employment change. That's kind of a biggie. And we'll get the advanced international trades in goods as well as retail and wholesale inventories. We'll get the second estimate for GDP. Now, if the number comes in at about or pretty much at what it was at before, that probably won't be a real big mover for the market. If it comes in hotter or weaker than expected, then that could really influence the market. And then we'll be getting pending home sales. Keeping an eye on all the different geopolitical events. Right now, it's about inflation, interest rates, growth concerns. And are we going to see a shift from a more pessimistic scenario over to a more positive scenario? Here's the updated economic calendar showing what's coming out on Wednesday. On Thursday, we will get the PCE prices. That's the Fed's favored measure of inflation. And then another big day will be Friday. We get the employment situation report and the ISM manufacturing index. For the stock traders almanac statistics, we're pretty negative with the Dow and S&P, where we're positive with the NASDAQ historically. Then looking at the four-year presidential election cycle, where are we starting to get that bounce as we get into the latter part of August? Also for the NASDAQ, are we starting to get that bounce? Then looking at the S&P during a pre-election year, we're following the green line, which is a pre-election after we had a midterm bear market, which was what 2022 was. Are we going to get some strength going into the latter part of August, which historically is what has happened? We will be on the 22nd trading day of the month, and then just looking at the pre-election cycle, where we follow the green dash line. That's the S&P, where it does have a tendency to be up on this day. So our scenarios, we're still kind of leaning more towards the down one, even though the technicals are turning more positive. We haven't really gone over to full-blown positive. Now, if you're more aggressive, you might want to go ahead. If we end up having an up day on Wednesday and look to close on an upward basis, and you're willing to take on some positions, you might want to do that. If we have a down day on Wednesday, then you might want to hold back on that. At least that's my approach to things. We're still kind of leaning a bit towards the sideways trend just because the ADX is below 20, both from the short term and the intermediate term. But if we see another solid up day on Wednesday, we could come out of that and start to show a new trend. So we're possibly shifting, but until we see more evidence, we kind of want to remain on the cautious side. The warning signs. Have we finally finished with these convergence, with this convergence of the short term or even intermediate term bearish signals? All of these things that are listed here, and I won't read them off, they kind of came together to pull us down throughout the month of August. Are we finally beyond that? We're still below those long-term trend lines on the weekly chart for the S&P and the NASDAQ 100. We want to get back above those lines to have things turn more positive in the longer term. Seasonally and historically, August has been a pretty weak month, but are we in a positive time now? Is this finally happening? Is it going to continue to play out? The equity put call ratio, it's starting to go back up and looking like it could be spiking again. The cumulative new highs, new lows showed a little bit of improvement on Tuesday, but they're still showing weakness in the longer term and have been for quite a while. The 3-month yield is still above where it was back in 2007, and it's not really moving all that much right now. And then we're dealing with earnings season on a case-by-case basis. Our positive signs, as I go over in the weekly video, the seasonality and setups, those are still in the background. The daily special K chart is positive. The weekly chart is still negative. The longer-term equity put call ratio had been declining, but it's turning up. Is it going to roll over and start to come back down if we shift more positive? The S&P is still above the downtrend channel upper line. The risk-on posture showing some improvement after it had been weakening on a short-term basis throughout August, but it was going up pretty solid back in July. Are we starting to see an improvement there? The S&P 500 oscillators are switching back to positive, not in the long term, and we need to see more follow-through. We're also seeing some improvement with the NASDAQ 100 oscillator that we've been watching. The S&P is outperforming utilities, and the staples to S&P 500 ratio is declining. These two together often give good support to the S&P. Is that going to happen this time? We've been saying this for a long time, and it wasn't helping the S&P. Is that going to shift now? The Russell, the small caps, and the mid caps are working off of recent golden crosses. Small and mid cap growth continues to be positive. The financial sector, even though it got hammered last week, is showing a bit of improvement and is still working off of a golden cross. The parabolic SAR daily chart is positive, and this is a new addition. The Copic curve has generated a buy signal. So our conclusion, we're turning more positive overall in the short term and in the intermediate term, but we have to see follow through here. In the long term, we still remain positive. Thank you. I hope you found this helpful. I hope you have a wonderful day, and I will talk to you in the next video.